Hi everyone! Thank you so much for tuning into my channel. My name is Destiny and I created this channel for overall wellness. I'm really into health and wellness and not just physical health, but I'm also into financial health, spiritual health, emotional health, and mental health as well. So to kick off this video, I actually wanted to start by talking about our financial health, and I wanted us to talk about and create a plan together to ensure that we have financial success, not just in the new year to come, but years to come after that. The first step in our financial plan, the first thing that we're going to do is we are basically going to start bookkeeping. What is bookkeeping and what does bookkeeping mean? Bookkeeping is basically using data that you get from your finances, data that you collect overall through the month. You're going to want to bookkeep every single month. You're also going to want to bookkeep quarterly, meaning that after every 4 months in the year, just to see if you're actually keeping up with your financial goals. And then, so when it comes to bookkeeping, what I personally do is I have a journal, right? Which is number 2. You need to keep a financial journal that you use to crunch all of your financial numbers, something that you can always reference to and see where you're at. I keep all of my receipts from all of my purchases, obviously not every single one because I tend to forget to keep them sometimes or I misplace them, but I typically keep them inside of my financial journal so that when I'm ready to do my bookkeeping, I can always have them ready to go. But I keep all of my receipts from all of my purchases so I can see exactly where my money is going and where my money is flowing to. That's really important, especially if you're trying to save or you're trying to make investments or you're trying, which you should generally, for good financial health, you should be doing all of these things, right? So the first point is we're going to be bookkeeping. Second of all, we need a financial journal that we use for our bookkeeping. We need to check in with that financial journal every single month and quarterly within the year, as well as an end of year report. So I have been keeping all of my receipts from this year because I did start being a lot more financially aware this year. I did keep all of my receipts from most of my purchases this year and I have them all. Today is the 30th of December and I'm going to do my end of year report. I'm basically going to go through all of the receipts from all of my purchases, crunch the numbers, and see where all of my money has been going, right? And I'm going to separate that into like different categories, which we're going to get into just now. The third thing you need to know about having good financial health is the 50, 30, and 20 rule. What is the 50, 30, and 20 rule, you ask? When your paycheck comes in or your salary, when it comes in, or whenever, 50% of it should always go towards all of your expenses, right? Your needs, your bills, whatever you need to get done, whatever needs to be paid off, all of that is included in your needs, in that 50%, and your expenses. So your needs and your expenses are the same thing. The 30% rule is 30% of your income should always be for you and for you to purchase or experience or pay for anything that you want specifically. So 30% of your income should be your wants, right? And then the 20% in the 50, 30, 20 rule is that you should always constantly be saving 20% of your income, which I do. So when it comes to saving, that 20% for me personally, I always make sure that 10% is going towards my emergency fund. And then I always make sure that the other 10% is going towards my retirement fund, right? So that brings us into our next point, which is you should 100% be having an emergency fund. That is something so important when it comes to financial responsibility that a lot of people don't probably think about, but should. As an adult, you are a human being, of course, having a human experience, but there are so many different things that can happen. Like anything can literally happen. You could break a leg and not be able to work for a certain amount of time. You could get sick, or you could get really sick and maybe your healthcare doesn't necessarily cover everything that you need. You could lose your job or lose your source of income, and you definitely, if you're around my age, then you're probably supporting yourself or learning how to support yourself or on that journey, and you need an emergency fund. So if you are single, that is not married, no kids, you can usually have an emergency fund you can calculate how much you need to save for an emergency fund based on your expenses. So all of your needs and all of the things that you need to sustain yourself, calculate how much you would essentially need to stay afloat. So your rent, your food, your utilities, whatever it is that's important to you. Calculate how much money you would typically need in a month to take care of all of that. And once you know, you need to be putting away some savings towards an emergency fund, which should be able to help you sustain yourself for about 3 to 6 months, right? The next thing that you're gonna need to do, create a plan, savings for your retirement fund, right? So a lot of people usually don't think about the future too deeply because we are human and, we're enjoying life as it is right now, and we don't really think too much about the future. But it's so important to think about your future because so many people don't plan properly for their retirement, and it's so sad. It's so sad that a lot of people don't plan for their retirement because at the end of the day, I mean, you've been an independent person your whole life, you've been sustaining yourself your whole life, and now you retire and maybe you don't have a proper retirement plan. You are kind of at the mercy of everyone else because now you're at the mercy of everybody else sustaining you and taking care of you, and your life might not necessarily look exactly how you want it to look if you are sadly found in that case. So I would definitely use that 20% from your salary and separate it. 10% should definitely be for your retirement and 10% should be for your emergency fund. When it comes to your retirement fund, you need to be smart with your retirement money. Instead of just constantly letting it sit in a bank, I'm not saying that you shouldn't have any retirement money at all in a bank. You should be using your retirement money to invest in other ventures that are going to bring more capital, things that are going to help you to earn a lot more revenue and a lot more money, right? You don't want to just keep the money, you want to multiply it. So that's something that you should think of when thinking of money or putting away money for a retirement. You should definitely think about using that money to invest so that it multiplies over time. By the time you retire, you'll be set for life. Another thing that you can also do when it comes to your retirement fund or retirement investments or money, I think it's really important to actually reach out to organizations like organizations that deal specifically with financial things like that, organizations that open up trusts for people, organizations that open up organizations that like sort out life insurance policies, organizations that are basically trustworthy, that have been around for a long time. For me personally, I live in Zim, and that would be like Old Mutual. And going to find out what kind of options they have, you would be really surprised to find out that they actually have a lot of options for people that have retirement money or money they would just like to invest, and obviously looking forward to receiving a return on that investment, and just creating a portfolio with them to help you manage all of your finances is definitely such a good thing to do in the long run. When it comes to bookkeeping, another thing that I would advise you to do is to make sure that when you are bookkeeping, when you're done with calculating all of your receipts and all of the amount of money that you've spent and where the cash has gone and all of that, I need you to make categories for whatever you're spending your money on and calculate how much money in percentages it is that you are spending on that category. For example, let's say you like shoes or you like clothes. You like to buy yourself clothes. You work hard. You want to spoil yourself. When you leave your house, you want to make sure that you're looking good. Nothing wrong with that. I want you to analyze how much money you are spending per month, how much money you've spent per month on your clothes. And then I want you to break that down into quarterly cycles. And then I want you to break that down into a yearly cycle in total. And once you do that, those percentages are going to let you know very clearly and see very clearly where your financial strengths are and where your financial weaknesses are and what you're actually doing with your money. The thing is with money is a lot of people think that when it comes to money, the more money you make, then the less problems you have. And that's not necessarily true, because a lot of people are in the top 1%, or could be in the top 1%, or are earning a lot more than the average person, but you would be surprised to know that they are actually living paycheck to paycheck. which reflects very poorly on their financial health and stability, as well as their financial habits. Because if you don't know how to manage the money that you have now, you're never going to get to a point where you have more and you know how to manage it better simply because you have more. It starts with all of these little steps that contribute to the entirety of your financial health. So you need to create a budget for every single month. You need to create a budget that you need to create a budget every single month for all of the things that you need, right? You need to categorize everything. You need to categorize everything. Find out what your needs are and all of your bills and things that have to be paid for. And find out what your wants are. What do I want to do every single month? These are the things that I want to make time for. Maybe they're your hobbies. Maybe it's just going out. Maybe it's just taking yourself out. Maybe it's the retail therapy and the shopping, something like that. Or maybe you want to take a vacation at some point and you are currently paying for different activities, one by one, or, planning ahead for the future, basically. You always want to make your budget before your money comes in so that you know exactly how to allocate all of your resources correctly. And it's easier to create a budget before your salary comes in because you obviously know, even if you're commission-based, you obviously have a rough idea of how much you are getting in at the end of the month, especially if you have a fixed income, So you can write down, again, in your financial journal, all of those individual things that you need to pay for, calculate how much it is going to cost you to pay for those things so that you can have a rough idea of what percentage of your salary out of that 50 that we talked about from the 50-20-30 is actually your needs. How much money do you actually need to cover everything that's within your needs? If you maybe need less than 50% of your salary or your paycheck to do that, that's great. You can divert those resources and probably start putting more in your start saving a lot more, or adding more money to your retirement fund. You just need to kind of take it step by step because it is a process and it's a never-ending one, but all of these individual steps will help you to get to exactly where you want to get to. The thing I'm going to talk about is the pay yourself first rule. What does this mean? Whenever you receive your income, the first thing that you need to do is to put money away for your future. So you need to essentially put that emergency fund money and that retirement fund money away first before you put anything else away. Before you pay any of your bills, before you pay for a single thing, those are the most important things that you need to do, is look out for you in the future, and that's exactly what you should do. So you make sure that you, if you have a bank account, you can create an automated system where when your paycheck comes in, a certain percentage of it just automatically goes to your savings account. That is brilliant. If not, if maybe you are paid on a cash-to-cash basis, as soon as you get paid, you need to take your ass to the bank and deposit that retirement and that emergency fund money, okay? Because if you want to do them last, there's always going to be something that comes up. There's always going to be a miscellaneous cost. Maybe your car breaks down. There's always going to be something. So once you put that money aside, then you yourself will also start to feel a lot more financially stable, less financially anxious, because you know that, okay, I am securing my future and this is what I have left to work with, and trust me, you will make it work. What I'm going to talk about is opening a savings account. It is so important to open a savings account. Yes, it's great to invest money. Yes, it's great to invest in stocks and bonds and whatever it is, and start new business ventures for yourself. However, it's even better to make sure that you have a savings account where you put your money away, right? It's always safer to keep your money at the bank. That way you can avoid getting robbed, moving around with lots of cash. You can avoid using it for other things that you don't necessarily intend to use it for. I remember I used to keep my money in a saving container. It was just a nightmare because as an adult, and at the time I didn't even have an emergency fund or anything, but I was trying to save, which doesn't really make any sense, but I'm pretty sure a lot of people do that. You probably do that. But I used to save my money and I used to put it in a saving can, one of those ones that you could open. And anytime something would come up, I would just open it and take the money. And then I started borrowing for myself. Like I would always tell myself, I'm going to return the money and I'm going to put it back in the can when I get paid next. And that would never happen. Like, I probably still owe myself money from telling myself that. So the safest thing you can do is keep it in a bank, because out of sight, out of mind. You can't touch it, you can't see it, you can't spend it. Also, the good thing about having a savings account is that it is heavily protected from a lot of charges, right? You don't get bank charges, at least at my bank. You have a lot of benefits when you open a savings account. You don't get transaction fees. So when you withdraw the money, it's essentially free of charge, right? Which is an amazing thing. It's brilliant. And then also, your savings account is protected from like bank charges, you know, like monthly charges. They charge you to keep your money in the bank. Savings accounts don't usually have like monthly charges. So whatever amount you put in your account is the amount that stays there, which I love. Hi, bestie. I'm just editing the video, but I realized that I forgot to tell you guys that when you open a savings account, they have an interest rate of about 2 to 3% of whatever you save, and they will give you 2 to 3% of whatever money you save annually. So that's also one of the benefits of opening a savings. But yeah, that would be all for today's video. Let me know if you guys would like me to expand on any one of my other points, or to teach you anything else. I wanted to keep this video short, sweet, super clear instructions, and I wish you the best of financial luck, but I will catch you next time, besties. Bye.